Thanks for clicking on my video. I really appreciate you taking the time out of your day to watch this. This is actually part 2 of why you shouldn't buy individual stocks. So if you haven't seen part 1 yet, go ahead and check in the description. There's a link to part 1. That way you'll have more context into what is being discussed in this video, which is part 2 of why you shouldn't buy individual stocks. So I just touched on you not being a professional in the previous section, but again, you're not a professional. I'm not a professional. I don't do this for a living. I don't research stocks as my actual job. Now, I used to do it in my free time, and I still do a little bit, but in order to simplify my investing strategy, and in order to free up time to spend with my family, with my friends, with my church, whoever you spend your time with, you'll have more time if you're not spending hours on end looking at the latest quarterly report, or looking at CNBC, or whatever news articles or news websites to try to figure out what's the next big thing, where you should put your money. You just automate it. You keep putting money into your account. You keep putting money into that index fund, and you watch it grow while you're sleeping, while you're at work doing your day job. And don't spend your free time trying to research those stocks. Just put it in an index fund. Now, a few of the reasons why I changed this strategy is, one, I'm targeting people that are either new to investing. Again, they don't have the time to research stocks. And as I was doing my own research and I'm reading books, and I'm learning that even most of the professional traders, 80 to 90% of them don't beat the market. So if you're not a professional and 80 to 90% of the professionals can't beat the market, what makes you think you can do it? What makes me think that I can beat the market if 80 to 90% of professional people aren't doing it? Now, you may do it once. You may do it a couple of years. But over the long term, it's very hard to beat what the market is giving you. So it's better to just put that money in the index fund. Now, you can't really get into speaking about index funds without going a little bit into the history of index funds. So that's where the actual book that I read comes into play. So John Bogle, who was the former CEO and founder of Vanguard, rest in peace, he actually passed away a month ago. He is actually the creator of the first index fund. So John Bogle wrote this book called The Little Book of Common Sense Investing. And within that book, he discusses why, for most people, investing in index funds is the way to go. Now, in this book, if you watch part 1, I mentioned that 80 to 90% of professionals can't beat the market. This is actually from his book where he mentioned that. So he's done the research as the head of Vanguard, and they determined that a low-cost index fund that's investing in the total stock market, 80 to 90% of the time, it's going to beat those professional investors out there. And so whether it's a professional investor buying individual stocks, or if it's a professional that has their own mutual fund or their own index fund, and they're charging that higher rate, most of the time they're not going to beat the market, for one, and then two, even if they are to beat the market for 1 or 2 or maybe 5 years at best, which are a very small percentage of the professional investors out there, the amount that they're going to beat the market by isn't going to be enough to make up the difference for what you're paying in the additional fees for the expense ratio. And since we're investing for the long term, we may be investing for 10, 20, 30, 40, maybe even 50 years. If you start when you're a teenager, if you start working that soon, you can start investing in index funds then. Now, with John Bogle being the creator of the first index fund, now he doesn't get any benefit from any other index funds out there. So if there's another company outside of Vanguard, there's no benefit to him to talk up index funds, other than to talk up how Vanguard is typically the lowest, has the lowest expense ratio out there. So maybe he's a little biased. he created the index fund. Of course, he wants you to put your money in an index fund. So let's talk about someone else that really, has no connection to Vanguard. And that would be a billionaire investor. His name's Warren Buffett. Warren Buffett stated that once he passes away, he's actually going to put his money into a Vanguard index fund. He's going to pick one of the lowest expense ratios index funds that they have. It's going to be the S&P 500. So it's not the total stock market. It's the S&P 500, which is a group of 500 stocks, which is a good representative of the U.S. stock market. Now, his wife or his children or family or whoever he's deciding to give his money to, either he doesn't trust them to, or maybe they don't have the knowledge that he has. Of course, there are many people out there that don't have the investing knowledge and experience that Warren Buffett has. So if he's going to trust to put his billions of dollars into a Vanguard index fund, and he's saying, make sure you worry about the expense ratio, don't spend too much money on that part of it, because you want to reduce the fees as much as you can, and just trust that the U.S. stock market is going to continuously make that 5 to 8% per year that it's done over the course of history. Why wouldn't you do the same thing? If I were you, and I'm not you, but I'm me, and I'm making the decision to put my money in index funds now at the lower expense ratio, preferably a Vanguard fund, but you can do your own research for other funds out there. I have heard that there is a fund that gives a 0.02% expense ratio, and these things may change over time. When you're watching this video, it may have gone up either for Vanguard or for the other funds out there, but you want to make sure that you're getting the lowest expense ratio that you can, because if you're paying a lot of fees over time, all the fees that you're paying, that's money that's not actually going towards stock, and it's not growing over that 10, 20, 30-year period. The next book that I read that confirmed this even more is called The Millionaire Next Door by Thomas Stanley. In his book, he discusses how, the average millionaire, and these are people that don't have $1 million income. These are people that make 30, 40, 50,000, maybe 100 or 200,000 on the high end if they're like a lawyer or something like that. But they were able to accumulate over $1 million in wealth in their lifetime. Now, there are many factors to that, dealing with budgeting, being disciplined with, putting money continuously in an account over time. But most of these millionaires, they were putting their money in index funds. They weren't taking the time out of their day because they're busy with their day jobs, they're busy with family, maybe they own their own business, and they had to put their focus on those things. And so they didn't want to spend that extra time to think about, okay, let me go look at a quarterly report, or let me follow this guy that's on the news, or let me follow, this random person that's telling me about, this penny stock that I should invest in. Don't invest in penny stocks, because that would take a lot of time to learn how to trade those things. But the main focus is that these millionaires, these people, these normal citizens of the U.S., these people that are making as low as $30,000 per year, they were able to grow their money to millions of dollars because they were consistent. They worried about, not spending as much on expenses for trading stocks, or, they decided not to trade individual stocks and put their money in an index fund. They decided not to trade individual stocks and to put their money in an index fund, and to automate that process, automate their savings, make sure that they're putting savings before any of the other spending that they're doing. That way, and again, that goes back to Warren Buffett as well. He has a great quote where, I'm paraphrasing, but it's basically, you save first and you spend what's left. If you spend first, you're more likely you're not going to save, because you're not going to have enough money left to save. Focus on saving and investing first, and then whatever your expenses are, you try to get those expenses to fit into the money that you have left, and that helps you with your budgeting as well. Now, in conclusion, we spoke about in part 1 and part 2, where I went over why I changed my strategy. I went over, how fees can eat up your money over time and reduce the amount of growth that you could have over time. So you definitely want to reduce those fees by, one, not picking individual stocks and putting your money in index funds, using platforms that don't charge a commission fee, don't charge a load fee for the index fund, and has a very low expense ratio. We also talked about, saving your time that you would have to spend to research and putting your money into individual stocks and just going with the total stock market. That way it's like, okay, well, I know my money is actually in every individual stock that's available in the US market. We also talked about how you're not a professional and how 80 to 90% of the professionals can't beat the market. So it's really a fool's errand to go out and actually try to beat the market, especially if it's not your job to actually research stocks. You have other things you need to do throughout your life. You have your day job, maybe you have a side hustle, maybe you own a business, and during your free time, you actually want to spend it with your friends, your family, and whoever you spend your time with. Now, I really appreciate you taking the time out of your day to watch this video. Again, if you did not watch part 1, go ahead and click the link in the description and check out part 1 so that this video will make more sense. If you did check out part 1, I really appreciate you checking out both videos. Make sure you subscribe to my channel. Make sure you like this video the same way you like part 1, and make sure you hit that notification bell if you haven't already, and you'll get notified whenever I make a new video. Again, thanks for watching, and I look forward to any questions or anything you have to say in the comments below. Really appreciate you watching. Have a great day.